All right, welcome everyone. This is Bob Maurer. It is Thursday, the 24th of October, around about 2:40ish my time. Want to do a deep dive into some strategies that were benchmarked relatively recently. See everything lined up for the entries. Go over the risk reward and also the backstory on each one of them. So I'm not going to do all four in one video. I'm going to do the first two here with you right now and then add the two other ones later. So you can look forward to that video also. Let's dial into the portal, see what we're dealing with here. Go into this week, the week of October 20. Here's our PDF. And here's the two I want to look at. So 329 in the middle here, bear spread in cotton, the DSMA. And we've already got the entries and exits detailed. And then 330 bear spread in the March May coffee C. And as you can see there, this started on the 21st and it was published before the market had gotten to, well, before we got to the 21st. So it was going to wait for the close on that day and then do the math on the entries and exits. So we'll go over those particulars and see where that all lined up. All right. So 329 bear spread cotton, 330 bear spread coffee. That's what we're going to dig into right now. So we'll start with the first one here, cotton. All right. So first of all, in yellow, going over the basics. Strategy number 329, bear spread in cotton, long May, short December, margin requirement just shy of $800 per spread. Approximate risk reward for more conservative entry level 2, risking 220 per spread to either make 635 or 775. And then for the more aggressive average in traders who get in at level 1 and 2, the risk per two lots that you're averaged into is 540, and then the gain would be around 1170 for target if we hit target 1 afterwards, 14.5 if we hit target 2. If all we do is get the first level and then it breaks on down to the first target, the gain would be 535. Okay, backstory on this one is it has been a profitable strategy 13 out of the last 15 years. The losing years were 2021 and 22, and I didn't see a whole lot of correlation between the chart you're looking at in front of you for the contracts we'll be involved with and those two losing years. The other year that kind of stuck out to me was 2012, and in that year, I don't see a whole lot of correlation in terms of the incoming price. Ours is negative 353, and in that year was farther away. But in terms of the chart structure, I would say it does look similar. So that is one thing to keep in mind, just the general oscillations in the market and the dip in entry. If you want to get a visual on that, first I want to show you two things. One is just generally how this year is sized up with years in the past. So the black line is 2024 and 5, right? The contracts you'll be in. All these other years are anywhere from 2004 to right now. And you can see at least there's room to go lower. So it's not like we're selling into lows. It looks like lows have been around negative 5 or 600, right? As low as that. Okay, so we're not necessarily in the middle of the pack, but we're not making new lows either. So there is room for it to move lower. So that, to me, is a good thing. The other visual I want to give you is the losing years and that unrealized loss year. So like I mentioned, 2021 and 22 were years in which this strategy lost money. So 2022 is the red line. Obviously, we came from a much wider spread, and the market was working its way lower into this and then found some kind of bounce. But it had been coming from a higher level, so maybe it wanted to get back there. And then the blue line is 2021, all right? And as you can see, higher price entry for the spread, the seasonal window between the red and the green line, and had a good pop to the upside, moved sideways, and then popped up again. So not a whole lot of correlation, in my opinion, in that chart structure, right, which is what I mentioned. However, the bottom line here was 2012, and that was a year that had an unrealized loss during the window, but ended up being a winner. Okay, and you can see that in 2012, the market basically moved sideways like we are doing right now, and even had little moves to the upside and rotations back down, similar to what we have now. And then when it entered the window, it had a big pop to the upside right away. So that is that unrealized loss. And then it slowly creeped on down. So even though the bulk of this spread in 2012 is very similar, in my opinion, to what we're trading with, the beginning part is not necessarily similar. So I don't necessarily think that that's going to be a bad thing. So that is why I'm not overly concerned about that, but I just want to make mention of it in case it's important to you. So we are going to get short. I think the other part that's kind of important here, the benchmark to stop range. So this thing was benchmarked on day 0, where it started at negative 353. Our stop is negative 263. That is 90 points. Each point in cotton is $5. So that's a $450 move. That would have been enough to stay on board 13 out of the last 15 years. So it's not 100%. Okay, so bear that in mind. But nonetheless, the bulk of the time over the last 15 years, that would have been ample amount. And we have to define the risk at some point. So what's the strategy? Well, take the benchmark, and we added a few points there for level 1, came in at negative 327. And this is revert back to the PDF. It'll show you exactly what the math was. And then for level 2, the entry came in at negative 307. Our stop is negative 263, and then our two targets are negative 434 and 462. So we want this market to bounce to the upside, kind of get a bounce off of this big break, retrace a bit, and then rotate back down. So far, it looks like the only entry level would have been level 1. So we're going to walk it forward as if we're filled there at level 1. See what happens. All right, so no change to the strategy at the moment. We've just been in this for about 4 or 5 trading days. So this is strategy number 329, bear spread in cotton, the DSME contract, DSME spread. And we've got the risk reward. We've got our entries and exit levels. I gave you some of the rationale, show you some visuals there. So that is why it was published. All right, so that's strategy number 329, bear spread in cotton. And then we'll move on to the coffee bear spread. So first of all, in yellow again, number 330, coffee C bear spread, long May 2025, short the March. So we're short in the deferred contracts. Margin requirement just shy of $500 per spread. Risk reward for regular entry, risking about 170 to make either 430-ish or 525. And then for the more aggressive average in traders, you'd be risking 488 per 2 lot that you average into to either make 712 or 900. If all you do is get level 1 and then we get out of target 1, then the gain would be about $280. Backstory on this one, it's been a profitable opportunity 13 out of the last 15 years, so just like the cotton that we just talked about. The 2 losing years were 2022 and in 2018. In my opinion, I don't think there's a whole lot of similarity either in price or the chart structure to those 2 losing years, so I'm not really concerned about that. And in terms of any kind of unrealized loss year that ended up being a gainer, that was an outsized unrealized loss, I don't see, nothing really stuck out to me, so I don't really think that's applicable in this scenario. Our benchmark to stop range, so this thing benchmarked at 190. That's where it settled on day 0, which was the 21st. Our stop is up here at 315. The math on that gives us room of $468, and that would have been ample room 15 out of the last 15 years to stay on board with this one. All right, just to give you a visual real quick, this is where we're at with this coffee. So the black line is us. Okay. And there is tons of room to move downside. Now, a counter argument would be that it's up here for a reason and it should stay up here based on the fundamentals. So I get that part. But as you can see back in 2023, okay, which is a similar year, generally speaking, with a big pop to the upside. So just last year, the market had the same backstory and did not hold. So slightly encouraging in that particular element of that. So it gives you a context that we're sitting way above normal meat of this spread. So we are doing a bit of a counter trend. And then another view is the 2 losing years that I mentioned. So these were the losing years, 22 and 2018. And in 22, you can see this market was primarily sideways, sitting in about a 100-point range for months before entering the window. And then it pretty much revisited the top end of the range. And then in 2018, bit of an even tighter range and just kind of drifted higher. So both of those were the losing years. And you can see the incoming price pretty different than where we're at. And generally chart structure completely different too. We saw a big rally and then holding up here for us, whereas this was just kind of a grind sideways for the most part. And then so was 2018. So I don't necessarily see a whole lot of correlation in the chart that we're looking at with the commodities futures that we are going to be involved with in those 2 other years. So all that considered, I published the strategy. It's a bit of a moot point, but I just wanted to go through that. Our attempt was to get shorts with price improvement, and the market broke pretty hard right out of the gate and through our both our targets, target 1 and 2. Now I'm gonna let this play out over a week or two, maybe. We'll see how this plays out over the next few days. Actually, we'll take it day by day. I'm gonna stay with it just in case there's a opportunity this thing to rally back up to the top end of this range and then fall back down. But essentially our entry levels, we're looking for price improvement. Our benchmark is 190. We've got entry level 1 at 230. I just put that in here. All right, so that is entry level 1, and then entry level 2 is up at 270. Stop is 315, and again, targets are 1 double and 130. So I'll let you know if we're gonna pull the plug on this one. Kind of did what it was supposed to do already, moved pretty quickly. But again, I like this pretty well established range, so I will reanalyze the data. Probably not tomorrow, maybe Monday, Tuesday. Give it a few days and see what happens here. And it did come down to almost touching the white line there, which is a 200 period moving average. So I would expect some kind of bounce, and we'll see how it plays out. So I'm going to stick with it for now, but be advised that I might be pulling the plug on this one. So that is coffee. So we've got the risk reward. Got our risk reward right here. Got our entries and exits. I gave you the backstory, gave you a couple visuals on some correlation years, and I think that should bring everybody up to speed. All right, well, those are strategies 329 and 330. 329, the bear spread in cotton, 330, the bear spread in coffee. If you have any questions, comments, anything of interest, feel free to let me know. I'm going to leave it there, and thanks so much for watching.